everyone! In this video, we will explain about SME cooperation in Malaysia. We will start from introduction of SME in Malaysia. Next, financing needs of SME. After that, we will go through to the financing problems of SME. After that, we will measure to ease the financing problems of SME. Lastly, we will find the sources of financing for SMEs and the financial impact of the different sources of finance on SME. Introduction of SME in Malaysia. Definition of SME. There are three definitions of SME that comes from three categories, which are: first, manufacturing sector. For the manufacturing sector, SMEs are defined as firms with sales turnover not exceeding 15 million ringgit Malaysia or number of full-time employees not exceeding 200. Second, services and other sectors. For the services and other sectors, SME are defined as firms with sales turnover not exceeding 20 million ringgit Malaysia or number of full-time employees not exceeding 75. And the last one is the new definition. Under the new definition, all SMEs must be entities registration with SSM or equivalent unit bodies.
Next, we will go to financing needs on SME. It is very important for SME to need a strong finance to development and market a new product. It because the business owner are always looking for opportunities to carry the business on the next level. Instead of that, the process modernization and diversification are really important to make the product different with their competitors. So the higher capital funding in the company can give the advantages to the business for make the product be sustainable for a long term in the market. Second, to pay for day-to-day running a business. To keep the ship afloat and ensure that all the operations are running smoothly, business need to have enough working capital. It is because they need to pay all the operation expense for make sure that the process of making the product can be effectively and efficiently as well. Example, they need to pay wages to employees, overhead costs, or paying vendors of raw material. The third point is to expanding a new business. As a business grows, it needs higher capacity and a new technology to cut the unit cost and keep up with competitors. Instead of that, it gives advantages to the business that have a higher funding to finance all of the capital. In fact, the cost of finance the new technology or machinery is seen as a long-term investment. When a business have both of this investment, the process of making the product are more quicker and they can get a lot of profit on their investment because of they produce a high quality product. Last but not least is to start up a business. All the owners of the business will need equity financing and the financing to finance all of the capital. It because when they start up the business, they will need a higher financing to cover all of the running costs. Instead of that, they need to hire all of the machinery that related to produce a product. So it takes some time before they can generate cash from sales to cover the costs since they are new in the market competitors.
Next is financial problems of SME. Poor planning. There is no financial projection such as startup costs, operating costs, taxes and fees, emergency expense, and estimated revenue. Some entrepreneurs take the incentive to just do it without having a pedagogical plan before start the business. It is easy for business to collapse sometimes before start the business. So, they need to prepare their financial projection before start the business. When there are cash needed to necessary expense, they are not reconsidered as the business plan. Next is honest living expense. Financial stress doesn't affect only startup employees. Problems related to financial management can extend to owners and their families. It is not unusual for owners to commit at least some of their personal assets to the development of a new business. Owners themselves often struggle to make ends meet while trying to build a business. Financial difficulties can impact every aspect of a business owner's life, including marital and family relationships. In some cases, entrepreneurs may eventually decide to shut their businesses down due to financial and personal stress, or they may feel forced to make business decisions on the basis of short-term profit rather than pursuing long-term and perhaps more lucrative opportunities and strategies. Lastly is lack of cash flow. Managing cash flow is a purposeful struggle for the most business owners. Having inadequate cash reserve is the main problem of cash flow. This situation leaves the business unprepared to handle unexpected circumstances and emergency. Some companies face overhead expense. These expenses are challenging because they are persistent. It will continuously affect the cash flow until it is corrected. Consequently, SME needs to manage their cash flow effectively to endure financial crises that may be faced in the future.
Okay, let's move on to the next point where I will be explaining about a few measures to ease the financing problem of SMEs. Firstly, by improving the corporate financial system and the understanding of financial management. The managers or the owners need to improve their understanding of financial management and enhance professional knowledge learning. They also need to implement the concept of financial management in the business and combine it with the actual development on financial management to blow up a proper enterprise development mode in terms of financial institution set. It needs to reform existing financial sector and set reasonable jobs of financial accounting related, where the financial system should be achievable by doing a job division and a job rotation. Job rotation should go as time successor should verify current accounts in order to strengthen supervision. Secondly, since the SMEs are such a large group, it also means that they can contribute significantly to the national economy. Hence, government aid is one of the measures to ease the financing problem of the SMEs, where the governments have increased the attractiveness of SMEs by increasing the marketability of shares, as the development of small firm markets is designed to bridge this funding gap and provide both a venue for further fundraising for SMEs. A low number of outstanding shares and a narrow investor base can make it difficult to sell SME shares. Introducing a market-making system may help. Relevant institutions also should be encouraged to publish periodic investment research on SME securities. And secondly, by giving tax incentives for the investors. This is to encourage and motivate SMEs to save more by reducing the amount of the tax that they need to pay when they're filing their taxes. As we can see, in Malaysia, these are the example of tax incentives that are given by the government to the tax residents companies. As the government are keen to support innovation, which is one area where SMEs often excel, and are keen to support the growth of SMEs as this boosts employment, the government assistance also is the measures to ease the financing problem. Where firstly, a government need to provide the SMEs with grants. It was a financial award given for a beneficial project or some sort to encourage the SMEs to more stable in the market. For example, there may be plans by the government or a council to revive or encourage the development of a sector or an area. And another example that also can offer the grants to SMEs for employing staff in certain industries and regions. Next, the government also needs to provide the SMEs with the equity investment. It is often done on a matching basis, where the organization will match any equity investment raised from other sources, as there are many countries have government-backed venture capital organizations that are willing to invest in the equity of SMEs. Furthermore, as for many SME owners and managers, especially those in micro firms, their business life is often lonely and isolated, and the owner managers seek a confidence to provide advice for their business. Hence, the government also liable for providing advice to SMEs to provide assistance to those who setting up and running a business, including advice on raising finance. And lastly, the government help the SMEs by guaranteeing loans. This to encourage new businesses by guaranteeing loans for SMEs with insufficient security. For instance, for a small fee from the SME, a large proportion of any loan advanced by a bank is guaranteed by the government. As this significantly reduces the risk to the bank, they are potentially more willing to lend. All these incentives are very important to help SMEs to ease their financing problems.
The last part is the source of finance for SME and the final impact of different sources of finance. The first source of finance for SME is personal financing. Personal finance is finance that is from personal saving, family, or either from a friend. This is often the starting point for most SME, where the owner uses his or her saving to start up the business. This is potentially a very good source of finance because these investors, such as family, may be willing to accept a lower return than many other investors as their intention to invest is not purely for finance. There is a pros and cons of using a personal financing. The pros is give much more control than other finance options. It means that the owner does not need to pay back or rely on outside investor or lender who could decide to withdraw their support at any time. The second one is to help to avoid excessive spending and know what to prioritize in business expenditure. Why? This is because you know exactly how much money you have. While the cost of having a personal financing is, if you find your business alone, you will have to develop your own contact and mentoring opportunities. Meanwhile, if you use any investor or venture capitalist, they can provide mentoring and networking opportunities for you and your business. The third source of financing by SME is by a bank loan. A loan is an amount of money borrowed from a bank for a set period with the aim of paying back at an agreed date. The repayment will depend on the size, length of the loan, and the rate of interest. The term and condition of loan vary with provider and may be negotiable. The riskier the business, the less likely to be able to borrow and the higher the interest rate charged. Why? This is because to help the bank to ensure that they are covered even if the risk does not pay off. The pros of using a bank loan. A bank loan money is based on the value of the business and its perceived ability to service the loan by making payment on time and in full. Unlike with equity finance, where the business issues share, banks do not take any ownership position in business, also do not get involved in any aspect of running a business. That means you get to retain a full management and control of your business with no external interference. The second one is loan do not require giving up part of the business as of the case for some investor, but the interest which serve as the cost must be paid. Some loans have a fixed interest rate which are easy to be calculated. While the cost of using a bank loan, most loans are not flexible. Once the payment date are fixed, they will have a strict terms and conditions. There also might be difficulty in making monthly repayment when customer don't pay on time. Therefore, it will causing a cash flow problem. The second one is most loans are secured against the business or the property or the asset of the business, but this property will be at risk if the business defaults. Lastly, the source of finance for SME is by venture capitalists. Venture capitalists invest large sum of money in return for a share in the firm's equity and also expect a good return on their investment. It is also known as a private equity finance. This source is often most time used in the early stage or a later stage depending on type of venture capitalist of developing a new business, where the risk of failure is high but the possible earning may also be high. The pros of having a venture capitalist is there is no obligation to repay the venture capitalist investor if the startup fail or shut down. Hence, venture funding is essential for startup. It doesn't leave the startup with the burden to pay back as is the case with the bank loan. The second one is a venture capitalist have a huge network of connection in the business community. This connection could be advantageous for the startup to grow and become more successful. They can help the startup to enter into alliance with the potential customer or business house. Meanwhile, the cons of having a venture capitalist is getting a deal with a venture capitalist may be a long and difficult process. Why? This is because as it will require you to drawing up a well-detailed plan, financial projection which may require professional help or a friend who have such a knowledge, and also a legal requirement may be needed on getting to the negotiation stage. All of this service will have to be paid for whether the fund will be secured or not.